The reversal had already started, the buyers were already in, and the headlines were still silent. I remember staring at the XRP chart that night because something about it felt wrong, or maybe more accurately, something felt too quiet. The market had spent weeks drifting lower, red candles stacking slowly on the daily chart, liquidity thinning, traders losing patience. Most people had already made up their minds. XRP was stuck. Again. Analysts on television were still repeating the same arguments they'd been making for months: regulatory pressure, uncertain adoption, competition from other networks. To the average investor, the story seemed settled, but the chart was telling a different story. Small green candles started appearing in the middle of a generally weak market, not explosive moves, just subtle pushes upward, quickly followed by controlled pullbacks. The kind of price action that usually gets ignored. Retail traders hate this phase. It feels boring, directionless, easy to dismiss. But experienced market watchers know something important about quiet markets. Silence often hides positioning, because while most traders were still focused on the negative narrative surrounding XRP, the order books were starting to look unusual, buy walls appearing beneath the price, liquidity suddenly deepening where it had previously been thin. Someone was absorbing supply, slowly, methodically, not chasing the market, but supporting it. At first I assumed it was just temporary stabilization, market makers stepping in to maintain liquidity. It happens all the time in digital asset markets, but then the volume changed. A series of transactions appeared on-chain, large transfers of XRP moving through wallets that had been dormant for months. Not retail wallets, not exchange hot wallets. These were institutional-sized positions, millions of dollars worth of XRP shifting quietly through the network. And the strange part was the timing, because at that moment, nothing in the news cycle justified the movement. No regulatory updates, no partnership announcements, no sudden change in macro conditions. Yet the buying continued, and by the time most traders woke up the next morning and noticed XRP beginning to climb, the accumulation phase had already ended, the reversal had already started, which forced me to ask a question that doesn't get discussed often enough in financial markets. What if the buying wasn't a reaction to the news? What if the buyers had already seen something coming? Because when I started tracing where those large XRP transactions had originated, I realized something that made the whole situation far more interesting. Several of the wallets involved weren't just whales, they were connected to liquidity channels used by major financial institutions, and that raised a possibility the mainstream conversation wasn't even considering. Maybe banks hadn't ignored XRP after all. Maybe they had just stopped talking about it, while quietly accumulating it in the background. And if that was true, then the reversal everyone was celebrating might have started long before anyone noticed. The first clue wasn't the rally. It was the moment the selling stopped working. For weeks, XRP had behaved like a market under pressure. Every attempt to move higher was quickly rejected. Sellers appeared almost instantly, pushing the price back toward familiar support levels. Retail traders know this feeling well. It's the phase where optimism slowly disappears. You watch small rallies fail again and again until eventually most investors stop believing the market can recover. But markets rarely turn around when everyone is watching. They reverse when everyone has already given up. Late one evening, something subtle changed inside the XRP order books. The price dipped again, continuing the same downward drift traders had grown used to. But this time, the reaction was different. Buyers appeared faster than usual. Large limit orders began stacking beneath the market price, not aggressive purchases chasing upward momentum, but quiet bids waiting patiently below the surface. This is how accumulation often begins. Institutional traders rarely buy into rising prices. Instead, they absorb supply during moments of weakness, allowing frustrated sellers to exit their positions. And that night, sellers were everywhere. Retail traders were closing positions after weeks of disappointing price action. Some believed regulatory uncertainty would continue suppressing XRP's growth. Others simply lost patience. Every sell order created an opportunity, and someone was clearly taking the other side of those trades. The candles on the chart didn't look dramatic, no explosive rally, no headlines announcing a breakout, just something subtle. The market stopped falling. In financial markets, that moment is often more important than the rally that follows. Because once the supply of sellers begins to dry up, price has only one direction left to go. The interesting part was that most traders didn't recognize what was happening. They were still focused on the narrative surrounding XRP rather than the structure of the market itself. But experienced participants know something critical about turning points. By the time the price visibly reverses, the accumulation phase has already finished. And judging by the unusual activity appearing on-chain that night, someone had already been accumulating for hours before the broader market noticed. Blockchain markets have one unusual advantage over traditional finance. Transactions leave fingerprints. Every movement of XRP across the network is recorded publicly. Anyone willing to examine the data closely enough can follow where large transfers originate and where they ultimately end up. So after noticing the unusual stabilization in the order books, I started reviewing on-chain activity from the same time period. That's when the first pattern appeared. Several large XRP wallets had suddenly become active again. These weren't the typical retail addresses that move small amounts between exchanges. These were institutional-sized wallets capable of shifting millions of dollars in a single transaction. Even more interesting was their recent history. Many of these addresses had remained completely dormant for months. No transfers, no liquidity movements, nothing. Then suddenly, within the same few hours that XRP stopped falling, they woke up. The transactions weren't chaotic either. They followed a very specific pattern. Large amounts of XRP were transferred from cold storage wallets into addresses connected to liquidity pools and exchange infrastructure, not dumped directly into the market but positioned where they could quietly interact with trading flows. This type of behavior usually indicates preparation. Large financial players often reposition liquidity before expecting increased market activity. They ensure enough depth exists to support heavier trading without creating extreme volatility. The question was obvious. Why prepare liquidity for XRP that night? At the time, nothing in the public news cycle explained the sudden activity. Financial media hadn't mentioned XRP that week. Major analysts weren't issuing bullish forecasts. Retail traders were still mostly distracted by movements in Bitcoin and macroeconomic headlines. Yet the blockchain data suggested something else entirely. Someone, or several large players, had decided the timing was right to move substantial amounts of XRP into active trading channels, and that suggested they expected something to happen. Not eventually. Soon. Because liquidity providers rarely reposition millions of dollars without anticipating a shift in market behavior, which meant one uncomfortable possibility had to be considered. The quiet buying pressure appearing in the XRP market might not have been speculative at all. It might have been preparation. Preparation for a reversal that the broader market hadn't even begun to notice yet.